Hello, this is Manesh Patel from IchimokuTrade.com. Today we're going to do another trade review. And the reason why is that I had a gentleman come to my office the other day, and basically he was talking about his option trading. A couple of things he was telling me that is that he continuously sits there and takes trades where he's risking 300 to make 500, less than 3 to 1. And what he's discovering is that basically is that in certain situations he does really good, and then in certain scenarios he starts losing, and when he loses he starts wiping out his profits and he doesn't really get ahead at all. So at the end of the day, after a couple of months of trading, he just basically breaks even, which is not good at all. Okay, so due to that, one of the things I'm doing is I'm actually doing a lot of trade reviews now with option trades from our option university that we have. um, so let's begin and start going through this. Let's go for a normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell a particular instrument. If you do so, you're doing that at your own risk. All the information is owned by EII Capital Group, and it cannot be distributed without written permission from us. We are broker neutral, so we do use various charting platforms from Thinkorswim, TradeStation, IG Markets, eSignal. Today we will be using Thinkorswim since we're dealing with options. Here are our contact details here, but let's go ahead and get to a trade. Now today we're going to do a little more sophisticated strategy and kind of go for a little more details with options. Okay, so one of the instruments that we looked at towards the end of July was specifically a stock called DEC, D-E-C-K, Decker's Outdoor Com. And what this was is that we were looking at this instrument based on earnings. Okay, so in our options university, we have two different strategies. One is pre-earnings and one is post-earnings. In pre-earnings, we really didn't see much at all at all on the charts, and the reason why is price was down here. So we really didn't see any opportunities as far as the technical chart was concerned before pre-earnings. So we waited for after earnings to see if there was a technical opportunity. Okay. Notice I'm not focusing first on options. The biggest difference between us and all the other option universities out there is that we don't start with option strategies at all. We start with technical analysis. Okay, we use, as you know, that we use Ichimoku as our indicator, so we're going to use technical analysis to tell us when we're at key support resistance values. Once we're at key support resistance values, then what we're going to do is we're going to use options to trade them. Okay, so that's a complete different philosophy from a lot of people out there. A lot of people think that majority of the stock markets go sideways, so at that point they're looking for option strategies that go sideways, and when they start going outside the range they start repairing them. We don't believe in that at all. Our whole idea is to do technical analysis, look for advantage, and then use options to trade it, either looking at straight calls and puts, or then start getting into other strategies such as verticals, calendars, and stuff like that. Okay, so again, back to this trade here. Before earnings, really nothing happened. After earnings, what we noticed was is that the stock here moved up, and it moves straight up here to this weekly green line here. That green line represents support resistance to 26 bars. So this was 26 weeks of a resistance right here. It went straight up to this level here and kind of held it. So what we're looking for is that since earnings sat there and moved this thing up, it moved it straight into resistance. So what we're looking for was a bearish trade, okay, right after earnings. And you could see here in Thinkorswim, if you kind of put your mouse over here, let me do this here, you could kind of see what the earnings was and so forth. You could see at the bottom all the information about it. So earnings was basically 7:30 at 3 p.m. After market. Okay, and remember this is a weekly chart, so this kind of represents the entire week. Okay, so again, we were looking for a short play. Now, after earnings, typically volatility goes down very low, so normally it's the best time to start looking for buying calls and puts. However, in this scenario, it was not the case at all, and this is one reason why you have to understand the Greeks in order to sit there and trade. So we looked at buying calls and puts, but we really didn't see advantage. Reason why is volatility was still high. We looked at vertical spreads, but we really didn't see any opportunities as far as vertical spreads were concerned. However, what we did notice is that we could do a calendar option where we could do a August-September calendar option, and this is what a risk graph looks like. Now, if you don't know what a calendar is, don't worry, I'm about to explain that to you in great detail in just a moment. But this is what the risk graph looks like. Now, what you want to always do is concentrate on the red line here. Reason why is that red line represents your P&L at expiration. Okay, so if you look at the chart here, the stock price was at $72. So when we put this trade on, this line right here, roughly the stock price was right about here. Okay, so that's what it looked like. So we were betting on this instrument going down. We were going to have a mouth that basically ranged from the break-even point roughly right here around $60.30, 37 cents, to about here, which is about $70.30. So that's the mouth that we were going to have. So if the stock at this red expiration, which is August 22, which is tomorrow, basically, if the stock gets in within this range here, we're going to make money. The maximum profit, of course, is right here, and at that point, we'll basically make $168. Okay, in this trade. And if you look at it, what's the max risk? If you look at the max risk here, and we're just going to sit there, equalize here, this is $67 to make roughly about $168. Now that's not quite 3 to 1, but look what we're about to do here. Okay, and the reason why is it doesn't look 3 to 1 from the option strategies here, but we are going to turn into a 3 to 1, and the reason why is it's because it's a calendar. Okay, in a calendar, you basically have two legs to the option strategy, where one is basically the front month, which is August here in this scenario, and the second one is basically September. So in this strategy here, we sold the 65 puts, and I'll show you exactly what we sold it for. So for $147 or $1.47. So we took in $147 here, and basically what we're doing is that in order for this option leg here to make money, the stock can tank, but it can't get below $65. And it really can't get below $65 minus $1.47, and that's really where our break even is, 65 minus $1.47. But in theory, you don't want it to get below $65 at all. If so, you could possibly get assigned. Sorry about that, I got my alerts here. Okay, so if that does not get below $65 a share by expiration, which is August 22, then we're basically going to get to keep the $1.47, $147 for the trade. Okay, so our whole goal was to choose this strike price so that it's at a support, so the chances of the stock getting below 65 was going to be a low probability. If so, we're going to take in $147. Okay, then what we wanted to do is that once that expires, which will be tomorrow, we now have a long-term put option here where it continues to bet on this instrument going down. Okay, and in that scenario here, we pay $2.14. Okay, so if we pay $2.14 and then we collect in 147, you could subtract the two, and you could realize is that the maximum what it cost us was roughly around $67 for this trade, which is our maximum risk. Okay, now the good thing is that if you look at the stock price today, it's right now right at $65.23. So as long as by tomorrow this stock here closes above 65, I'm going to collect $143 here for this trade. I'm going to take that. I get to keep that $147. Now what happens is this bought leg here, right? Remember? And if you look at it here, I could actually sit there. The mark price right now is I bought it for $215. I could sell it for $225. So I could take and sell this in the market right now for about another 10 cents in profit. Okay, so net I walk away with this for $150 in profit if I close this out Monday when this expires. What the best part is that I could walk away from this $150 roughly with profit Monday after that August expiration, or I could sit there and let this keep on riding if I believe this is going to sit there and technically keep on going down. And you could see here from the weekly basis, this is closing below the support here. So this does have a high probability of it keep on going down. So now what happens is I actually have, I'll sit there in this trade here. I'll actually have this call here, this leg right here. I'll have this leg here, and I could sit there and keep on making money on this as long as it keeps on going down, 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 down. Okay? So this right here, believe it or not, this risk graph will change, and what it will change to is it'll look like a single put after this one expires. This is how you trade. You got to start with technical analysis, put on the strategy, option strategy to sit there and fit your technical requirements. And if you do that, you then have the ability to sit there, get a 3-to-1 reward risk ratio or higher. Okay? And that's really how you should be trading options. I understand a lot of people tell you you can make 10%, 5%, 6%, 15% in options. But how much is that really going to be worth it? If you think about it, if you sit there and basically buy something for $66 and you sit there and make 10% gain, and then you got to count in your commissions, you're really not making that much at all. And you really can't sit there and say that's a great profitable trade. Reason why is that if you get some losing trades, your winning trades will not sit there and take care of your losing trades at all. So you have to have the ability to make a 3-to-1 reward risk ratio, or in turn, you have to have the ability to make a 300% profit on these trades, 300% or more. If you don't, your winners will never take care of your losing trades to a point when the markets are going the opposite way that you feel like it is going. You're not going to have ability to sit there and break even or even still be profitable. You're going to dig a hole which you're going to have a hard time getting out of. And if you think about it right now, there's a lot of people, believe it or not, hurting, and the reason why is because the U.S. stock market, if you look at it, has gone down drastically here. You could see this big red bar this week, and if you look here on the daily time frame, you could see this big drastic move here, and it's right on the week of option expiry. So a lot of people that had option trades are really hurting because they thought the stock market was going to range between here, and unfortunately it did not happen. And a lot of people's profits for the last couple of months, believe it or not, going to be wiped out this month. You cannot allow that to happen to you at all. Trust me, I was a retail trader doing the same thing, was in those scenarios, but I got out of it. You have to get out of that scenario, and the only way you can is for education. You have to understand technical analysis, and then you have to understand the options. And that's some of the things that we teach you in the Options University, along with money management and psychology. Okay, here's our contact information here, just in case if you have any questions. Thank you.